Hello. Today we're going to talk about a big picture topic and how that impacts you as someone that's transacting or planning to transact in real estate, or you just want to know what's going on and how that relates to you and your situation. Okay. So today's topic. Let me get a little bit of coffee. Hold on. Today's topic is big picture. The Federal Reserve has lowered rates by 75 basis points since September 2024 through November after the election. But why are rates up almost 100 basis points, creating a divergence of almost 1.4% from what the Fed has cut to where rates have gone? Okay. Now, we created a blog post, and the purpose of this video is just go through this blog post and give a little bit more color and insight on what I'm thinking and what I think might be going on from a big picture standpoint and how that may impact you. All right, so here's a blog post. You'll have a link to this in the description. And then there's source documents as well that you can click on to look at the same charts that I have in the document from the blog post. Okay, so in September 2024, the Federal Reserve lowered rates by 50 basis points. And then again by 25 basis points in November 2024 after the election. All right. So in total, they have reduced rates by 75 basis points from September, and today is December 12th, 2024. They may reduce it another 25 basis points later in December. We'll see. But since they have done that, mortgage and vehicle finance rates have increased between 70 to 90 basis points. Okay, you can kind of see this is from mortgagenewsdaily.com. You can go there yourself and look at this. But this is when they cut it. So you see the 50 basis point cut and another 25 basis point cut. And rates for mortgages, this is not for vehicle finance, this is just for mortgages. They have increased since then. At one point, it was up, 100 basis points from when they cut it. And then it's since then come down a little bit. But today, on the 12th, after PPI numbers were released, rates kind of started going back up. So it remains to be seen what the long-term trend is, but I'm just talking about since September to now, why is there such a big divergence? Okay, I can try to explain that, and if you have a better idea, please comment below. If not, this is what I believe happened. All right, and this is only my opinion, not financial advice. Okay, so when the Federal Reserve changes their target rate, okay, that is typically for short-term loans. Okay, loans like 2 to 3 month maturity periods. And what this does is it typically impacts business loans primarily. It does not necessarily reduce long-term rates for like mortgages. All right, that's because business loans are typically priced. They're floating, and they are typically priced on 30, 60, 90-day terms. All right, so this Federal Reserve rate cut impacts the short end of the yield curve and not the long end. Okay, the mortgage and vehicle finance market is priced off of longer term US Treasury bonds like the 10-year bond. The Federal Reserve has little control of the longer term bonds unless they are doing quantitative easing. I'm not going to go into that in this video. If you want to know more about that, comment below, and maybe if there's enough comments, I'll do a video about that. This is what happened. This is the 10-year US Treasury bond yield. So you can kind of see it's done the same thing as what mortgage rates have done. Okay. Now the scale is a little bit different in these two different charts, but you can see the trend is very similar, and that's because mortgages and vehicle loans are typically priced off of the 10-year Treasury bond. Okay. Now, typically, organic drivers for U.S. Treasuries are, among other things, inflation and credit quality. Okay. Well, since the cut by the Fed, there was a period where rates really jumped up pretty aggressively. You can kind of see that right here. That's pretty aggressive in my opinion. All right. So why has that happened? Okay. And no one's talking about it in the mainstream media except for a couple of specialized finance newspapers, so to speak. Well, international large institutional investors measure their performance on bonds relative to inflation. For example, if inflation is 2.5% and bonds are yielding 5%, and bonds, excuse me, I'm messing up here. I need to put on my smart glasses. Give me a second. All right, this feels much better. All right, so for example, if inflation is 2.5% and bonds are yielding 5%, then the real return is 2.5%. Okay, you get that? So if inflation is increasing or investors are expecting higher inflation, investors require a higher rate of return to remain invested or invest in a certain bond. That also applies to US Treasuries, just as it applies to corporate bonds. With that said, based on CPI and PPI data from the US government, you can access this stuff yourself, which is likely the reason behind long-term bond rates going up, because the data has been showing that inflation is coming back. It doesn't seem to be transitory here, as some people have said in the past. This translates to mortgage rates being higher because they are priced off of the 10-year bond, as we had said earlier. Now, what does that mean for buyers, sellers, renters, multifamily, and commercial investors? Okay. Well, for buyers, higher rates may reduce transaction activity, opening up people for better negotiation opportunities. But the downside is your monthly costs for a mortgage will go up. Now, we're actually already seeing this. Transaction activity for the United States for resale transactions has decreased significantly, as I'm sure you may have seen in some news articles. We can touch on that in a separate video if you want me to. Please comment below. Sellers no longer are in a market environment where you have 3 to 4% interest rates and multiple buyers bidding on your home. So now sellers have to play the negotiation game. They have to pay attention to what comparable sales are doing in their local area, and they may have to reduce price if there's not enough activity to get an offer, and they must be more willing to negotiate. Renters may see rents increasing if inflation continues to accelerate. With multifamily, cap rates, which is a tool, a measuring tool used to when you're transacting in commercial properties. There's lots of other tools in there, but we're just going to talk about cap rates because that's a pretty simple way to look for it. Cap rate is basically the percentage. Cap rate is the annual income for a property divided by the purchase price that an investor has paid for the property. Now, when cap rates go up, that means either two things have to happen. Incomes on those properties go up or prices go down. Now, you can have overall price stability if cap rates go up, but also the income goes up. That way the price on that property stays, relatively unchanged. Or if income does not change and cap rates go up, the value of that property will go down. All right. So that's the situation there. And cap rates typically are driven by what the investor benchmarks their investments against. Now, for example, if they benchmarked it against the 10-year Treasury yield, well, that's going up. So now you have to have a cap rate that's higher than what you're going to be paying for the financing for this property you're purchasing. Okay, so that's an interesting dynamic. It still remains to be seen what's happening in that market. Different markets are reacting differently to these things. So it all depends on what's going on in your local market. Same thing for commercial. Same thing's happening there. Okay. Now there's different subsections of commercial that are trending differently and differently in different parts of the country. But all these things are going to be impacted simply by rates going up or down. All right. Now I write these blogs, and I'm doing this video to kind of explain what's going on from the perspective of the overall picture. Okay. And all these things are pretty new to people because for the past 15 years, we've had declining rates. If rates continue to go up, it kind of changes how people are going to be looking at these things. So that's why I'm doing this, because if inflation continues to go up, unless there's an artificial decrease of the interest rates through quantitative easing, you're going to have this kind of situation to deal with here. All right. So remember, all these topics are discussed based on what's going on right now. These things may change on a weekly basis. So based on what's going on in the market. So this is not financial advice. This is just ideas that I'm sharing to try to give people a better picture of what's going on. If you disagree or have a better understanding of the situation, please comment and back it up with some data. And I totally don't care. I mean, I think it's good for people to add more information and to sort this out with the correct answer to this situation rather than not doing that. So remember, if you want me to talk about other topics, put your comments below on what you want me to discuss, and maybe I'll discuss that if I have some time. Until then, be nice and have a great day. All right, take care.